So thank you so much, Elizabeth, for speaking to us. We listened in to your panel discussion earlier, and we'd just like to speak to you about some of the items you discussed in that panel. And so just to start us off, and just sort of to give us a background on our conversation, Kenya's capital market have seen some important developments in the recent past, especially in the bond market with the new developments. So from where you sit, what do you think these developments are telling us about the direction of Kenya's capital markets?
Okay, thank you very much. I think what we are seeing in the market, one is that investors or Kenyans are ready to invest because they are putting money aside, they are postponing consumption and saying, this is money that I want to put aside for future use, and that is why they are investing. So that's a very good development. Now with savings, it then means that we translate it to investments. And the kind of investments they're choosing is what is most popular. So in this case, we saw them taking the IFBs. First of all, congratulations to CBK for really marketing and creating that awareness around an IFB and attracting such kind of massive attention. I think it tells you that other asset classes can get an allocation if awareness is created. So there's an opportunity for our economy to create an awareness around other asset classes so that we can allocate this capital that is being put together by investors through savings and take it to the real economy. So my hope is that going forward, we'll see more allocation of funds from basic government investments to the real economy, to equities, to alternatives, and to property, assets which are not necessarily standalone assets.
Thank you so much for that. So the panel that you sat in today discussed a lot on capital allocation. Given the economic environment that Kenya finds itself in now, what do you think are some of the key factors that are influencing both institutional and retail investors in making, investment decisions?
A key consideration for anybody who is allocating capital today is, first of all, to beat inflation. And we are aware that in the current environment, there are fears that inflation could actually go higher, especially because of the geopolitical tensions that are still going on in the East. Of course, in the Kenyan space, we have our own challenges around the food production this year and the El Nino. So with those kind of fears lingering in our minds, I see most investors wanting, first of all, to invest to beat inflation and to protect the wealth that they have already created. So all portfolios are looking for investments that are inflation beating and of course promising higher returns. And that is happening across most of the asset classes, and hence the allocation to especially fixed income, which looks low risk and yet giving you maybe even a double-digit return. Yeah.
Thank you so much. So in your view, what do you see as some of the structural barriers that prevent capital from flowing in the sectors that they are needed most and where they can make the most and the greatest impact?
One is awareness that fund management, especially because they are the catalyst and the people who are expected to be the intermediaries between the retail investors and the market, they haven't created that great awareness around other products. So the main product that has a lot of awareness among Kenyans is money market funds. So that is one of the biggest barriers. Then the other barrier is fear of losing capital. So most Kenyans have these anchored buyers that they always want to invest in the lowest risk but with the highest return. So that inverse kind of mindset has made them to remain very short-term in terms of how they invest and actually leave out other assets that are giving you double-digit returns. Case in point, look at the NSC, NSC market. The NSC market has been booming now for more than 2 years and making strong 50+ return. However, the participation in this kind of asset class is still low because of the awareness and the fear that markets may go down. So I believe that fear is one of the things that we need to overcome, and of course, knowledge around investing for the long term and not on the short term.
Wrapping up our conversation here with Elizabeth, and just to our last question, for companies looking to raise capital today, how has the conversation with investors changed compared to a couple of years back? And what are investors now demanding perhaps that they never really actually demanded in the past?
So among the things that we look at when from companies that are coming to look for capital is especially corporate governance. I think one of the failures that Kenya has had is that we have been open to to allocate capital to the private sector, but there have been instances when money that has been allocated in the private sector has actually been lost. So, and when you look at those case studies, you find that corporate governance has been the biggest factor driving the losses that were in the market. So when you come to look for capital in our market today, one of the major areas that we'll pay most attention to, other than the profitability and the future of the business, is the corporate governance structures that a company has. So that is fundamental and very important. And as we build resilient companies, the owners of businesses need to build strong internal controls, strong compliance controls, and of course, corporate governance that is anchored on ethical practices. That will give them access to capital from institutional investors who are looking to allocate. And you can see how that has panned out with the corporations that have come to look for money this year, especially using the MTNs and the corporate bonds that have come to the market. The oversubscription speaks to their corporate governance structures, and they get the money. So really, there's money to be allocated to the right corporates. That's